Hey everyone, I'm Andrew with Jesani Wealth Management. And let's just say that you have two investments that you're looking at. It could be anything. It could be a stock versus an index, or a fund versus a different mutual fund, or a hedge fund versus an index of stocks. And of course, you're going to have different returns. Some investments are going to have a higher return than other investments, but the question becomes, at what level of risk taken on by the investor? So let's say you have one investment with a 12% return, another one with a 10% return. Which one's better? Of course, the 12% gives a better return, but which one has more risk? Most likely the 12%. So how can you figure out what the risk-adjusted return, or the return of an investment assuming the same amount of risk as the investment you're comparing it against? So this illustration shows that, and I will walk you through it. So this is called risk-adjusted return. Very important when you're mixing assets into a portfolio. But risk-adjusted return is really the return of an investment if its risk level was the same as the benchmark. In our case, we're going to use the market, which is down here on the bottom right. So these bottom numbers, the risk level, are actually just standard deviation, which you can really find in the term sheet or prospectus or fact sheet for any stock or fund, whether public or private, that's out there. So the risk rate, or the standard deviation for our fund that we want to compare to the index, which is going to be Fund A, is 7.33% return, 11.04% standard deviation. Now, let's say we want to compare that to an index, which is over here, the market, which shows that we have a 23.11% standard deviation. So much higher standard deviation. So the way to figure out what the equal return of our fund would be at the same risk level that we're comparing it against to determine which is a better investment is simply by taking the return of the asset, which in this case Fund A is 7.33, and subtracting out the risk-free rate. Now, really the risk-free rate is 0, because every investment out there has some level of risk. But for the purposes here, most investors and managers are using the 3-month Treasury as the risk-free rate, which right now is about 0.67. The reason that's used is short-term debt, the depth and liquidity of the government securities markets, and it's the U.S. government. So this changes from day to day. So this is one of the numbers that you'll have to adjust and input as you're going through this calculation. But anyway, we're going to take the return of the asset minus the risk-free rate, which is going to give us 6.66%, which I will go ahead and just put that right here, 6.66. Now we're going to go over to the next part of the equation, which is talking about risk. So we're taking the risk of the market that we're comparing to, which is down here. Risk can also, you can interchange that with standard deviation. So our market risk in this case was 23.11. So this number is going to be 23.11, and we're going to divide that by the risk or standard deviation of the asset, which is 11.04, which is going to give us 2.09. So we know that our asset that we're looking at has a lower risk, so we're going to get a bump up of 2.09. Then the next step is that we're going to multiply the two, so the 2.09 by 6.66, and that will give us 13.94. And then we're going to add the risk-free rate back onto that 13.94, which is going to give us this number right here, the 14.62. So what that tells us is that if our fund that we're considering or trying to compare is yielding 7.33%, we have an 11.04% standard deviation. If that fund had a standard deviation of 23.11, our risk-adjusted return is 14.62. So let's just say that market or index that we're comparing it to has a return of 13%. And of course, we know we have a standard deviation of 23.11. Well, then we know that Fund A may be a better investment opportunity because our risk-adjusted return is higher than that of the fund that we're comparing it to at 14.62. So the reason that this becomes important, particularly when building a portfolio of asset classes with different risk levels and trying to create a portfolio of low correlation, is that you can actually directly compare returns between investments while considering the risk that the investor is taking on through the purchase of that investment. It also takes into consideration the changes in the risk-free rate, or in this case, we're using that 3-month treasury, which the Sharpe ratio, which is another way to calculate risk versus return, does not, and I'll go over that in another video. But most importantly, allows for a direct return comparison to a benchmark or the market. So this can be used really for any stock or fund versus any other stock or fund. So if you just want to compare your shares of Amazon stock, you have the standard deviation compared versus the market, you can see which one has a better risk-adjusted return. That market can be the S&P, it can be the technology index, could really be anything that you want. So if you have any questions about risk-adjusted return or how we use that in designing our portfolios and our 3D asset allocation models, certainly more than happy to speak with you. My name is Andrew Constantinidis, and my number is 954-800-8552. Thanks, everyone. Take care.